This is the Friday, May 24th, 2013 version of the Market Plus segment. Joining us now is Jamey Kohake. Jamey, welcome back.
Thanks, Mike.
We've got a lot of questions here, and I think they're really great follow-ups to what we talked about on the show. We'll start off with continuing talking about corn. Rob in Chicago is asking, what's your take on the cash corn market in July and August after the July futures roll off? Will we see $1.50 to $2 over the September contract? What do you think?
I think you can see $1 over pretty much where we are now, $1.25. I think that's pushing it because the game seems to be late summer, early harvest. We shut down for the old maintenance trick. And I could see that happening again this year despite the short supplies. And I also think feed yards will be more aggressive than they already are now, using wheat to blend. And so I think we'll see a little bit of that help out with the supply situation. But I think Rob is right. The big move is going to happen post first notice day when there's nobody in there but a few commercials and pretty much nobody's left again.
And then the gloves are off.
Yeah.
And we'll see what happens.
Exactly.
All right. We've got Denise asking about the new crop corn. We saw a tremendous amount of planting happen in the last week. We moved from 28% to 71% completed. And she's asking, does planting all those corn acres in such a short time frame put those acres at risk for pollination at the same time, or if it frosts early, as we look at summer heat or early frost?
Yeah, I think she's exactly right that it does. We planted roughly 43 million acres last week, about 9 million just in Iowa. So, I mean, some guys just running, daylight to dark, 24/7.
Certainly.
But yeah, the market is not reflecting that at all either. And that's why I said during the show that I don't want to stay married to my hedges. 100-day moving average, I think, has to be an exit plan. You get short at 550, you close above it, you got to be out based off of weather. September call options, I think, are a great play for something like this. Because the late harvest, run into tight, like Rob was saying, tight situations, August time period, and those September calls give you some time to see what's out ahead for that. So yeah, you could buy some cheap calls in September to protect you.
And be able to possibly take advantage of any large price swings there with a weather scare.
Yeah, weather scare, early frost, late, we don't start combining across Iowa until Halloween or something crazy like that. Yeah, you get to, play around a little bit more than the July would give you.
Certainly. So the market isn't reflecting it now, but by planting that 43 million acres, we've really potentially sown the seeds for a large weather scare.
Very easily could be, yeah. Dire heat, something like that. And like I was saying, the market does not seem to carry one bit yet right now, which could make it stronger longer term if we did get wild.
All right. Well, now Phil in Ontario is asking, as we switch to beans, how high could old crop soybeans go potentially before August 15th?
See, I'm in the same situation here. I was telling Rob that I think the big move, the big money, is made into delivery after first notice day when the specs are out, Agrodome and I and you are out, and we can't play it. I think they could go plus 16, but I don't think it's going to be before first notice day.
Okay, so wait until we get that notice day and then...
Yeah, I think they go nuts. Like you're saying, the gloves are off, the limits are off, and here we go, but there's nobody in there but a couple of commercials.
All right. Now, as we talk about soybeans, Dave in Illinois is asking, why does China continue to buy our soybeans and soy products? Is it simply a price difference, or are we still looking at significant trouble out of South America?
We've had trouble there lately. We got strikes down in Argentina. There was rumors they were off last night, Thursday night, that was not confirmed on Friday. But yeah, there's port strikes, and a little bit at times has to do with pricing. That's not the case right now. It's the ports backed up the strikes there. That's shifted the demand to us.
And now, as we look at these strikes, even if the strikes were called off yesterday night, Thursday night, how quick is it going to take to turn around to get that demand off America's backs? Or are we going to continue to benefit from those strikes for another week, month, 2 weeks?
Oh, I think it could take probably a month to 2 months. Just here a couple months ago, I mean, they're miles backed up at the ports, 3 miles at one time. So that demand, routine business, would still come to us short term. I think it'd take about 60 days to see a big difference. But right now, the beans aren't seeing a monstrous amount being exported. It's routine business. China has released some out of their reserves. So I think they're just pretty much going hand to mouth right now.
Waiting until prices break and they can get a better deal out of South America. Now, speaking of Argentina, and particularly the ports in Argentina, Troy in Iowa is asking, if they privatize the ports in Argentina, will it make grain movement that much faster? And how long would it take to make the infrastructure changes to make that happen?
I still think they're years away from really being a big player, which they could be with us worldwide. It's just not the ports that are backed up. It's not the dock workers off on strike nonstop every year. It's the transportation to the ports too. The roads are horrendous. There's not a lot of storage yet. I mean, Cargill, Bunge's got some plants down there, but there's still, along the road moving forward. So I think it's probably 2 to 5 years before they become a major player and kick us out of the market.
And that's assuming they start now on really ramping up their infrastructure improvements.
We're still going to be the major supplier to the world, always have been, always will be. We're more efficient, more productive, and I don't think there's any fears at all that we're going to be playing second base behind South America.
And with that in mind, assuming they get this privatization and the infrastructure improvements completed here in the next 5 years, what effect would that have on U.S. soybean producers? We'd essentially lose export demand in the summer?
Demand would slow down. Prices could essentially go lower to attract new demand, to be more competitive with them. But it's a long ways down the road. China's got a lot of tricks, with their purchasing here with us, with the futures market that they seem to do. They sell it off, buy it, and back and forth. So I don't think it's anything to lose sleep on here short term.
It'll be a market change that we'll adjust to, as we've adjusted to so many before. Now, before we let you go, Jamey, I was wondering if you had any thoughts on a trade of the week, anything that really jumps out at you this week.
I like the bottoming formation that's starting to occur in cattle. I like selling some deep out-of-the-money puts, like some 114, 116 August puts, get some decent premium there. I would write those. Look for the cattle market to go more sideways and slow and the bottoming action to occur.
All right. So something to keep in mind for those of you watching. Thank you so much, Jamey, for being with us tonight. And thanks to all of you for continuing to send in your Facebook and Twitter questions. We really appreciate it, and we'll continue to have experts get you excellent answers. Hope you have a great week. Thanks for watching Market to Market.